welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Coming in on the softer, more pessimistic side of that. So we think 120,000 payroll jobs added, which is a bit below, below consensus expectations. Clearly a further slowing. But I think the most important part of this Friday's data is that unemployment rate. And there we are also more pessimistic. We think the unemployment rate will rise to 4.4%. We're already very close to rounding to 4.3%. We're essentially back at the highs that we reached a couple months ago.
President Trump's been very clear on what he wants to do with tariffs, and he said some minimal level of tariffs, 10 to 20% across the board, and China at 60. Those numbers obviously can change, but to come out and say that we're not going to be as high as what he'd been saying, and it's going to be targeted, is definitely putting the cart way in front of the horse. So when I saw that story, I said that didn't make any sense to me, and certainly President Trump admitted as much.
Surprise announcement. Fed Vice Chair of Supervision Michael Barr has announced he will step down from the position of Vice Chair of Supervision effective February 28th, but will continue serving as a governor on the Federal Reserve Board of Governors.
We got 1 hour to go until the market close. We're seeing a little bit of deterioration here as we head into the afternoon. The Dow now off by about 30 points here. Very slightly negative on a percentage basis. The S&P 500 still up by 0.4%, but fading as the session goes on. And the Nasdaq up about 0.9%, but similar story there. We're watching the bond market as well here. It's held fairly steady throughout the session, but gaining a little bit of ground, and that's going to be something, of course, that investors are watching.
You know, we ended the year there, Julie, after a really stellar run with the market sort of losing some steam. And so you're starting here, in new year 2025, and you're kind of wondering, there's some green on the screen, you're wondering if that's going to stick. Same questions, frankly, we still have. We're still watching, you just pointed out, we're still watching yields. We're still watching that mega AI trade with Nvidia CEO Jensen Huang speaking tonight at CES. That, of course, big moment, traders, investors watching that closely.
Yeah, and in advance of that, we are seeing a pretty strong bid today to some of those as semiconductor and AI universe names, right? We've got communication services helping lead games, as well as infotech materials in the mix there as well. Real estate, consumer staples, utilities, so rotation out of some of the more defensive names into some of the more cyclical names, which is interesting. And then to your point about what we're seeing, Nvidia itself up about 3.5%, and could close at a record high today. We're watching those levels. Alphabet could also close at a record today. And then we're also seeing strength in stocks like Meta. With CES going on, a lot of excitement over maybe some new AI-related stuff that might end up getting announced.
Generally,
yes.
The place to be. I mean, you look at the MAGs, the ETF that tracks the Magnificent Seven, tacking on another 1.5% today.
But after what had been sort of a downward drift in many of those names after the Fed meeting, which sort of seemed to be the turning point in December. I mean, if you take Nvidia as just one example there, let's look at a one-year chart, pull it back here. Of course, it's up a lot over the past year, but the previous high that it had was sort of November, then it languished for a little bit before coming back up here and reattaining that high.
Yeah, and then Washington also, fiscal policy was front and center today too, Julie.
Yes.
You had different headlines, one saying Trump team was rethinking the tariff strategy. Trump comes out and says, not really, I'm non-true social. So that, again, we're in the middle of headlines as well. For more on the latest moves, let's welcome in now John Augustine to talk more about these markets. John, you say, looking ahead, there are some key areas we need to focus on, John. For investors, walk us through those. What do we need to be aware of in terms of, at least right now, what should be on our radar?
3 Ps, profits, so that starts the middle of the month, quarterly earnings season. Then policy, that's what we've been talking about today, specifically tariff policy. Then the third thing is productivity that we need to be talking about this year. Productivity, in our view, is what's going to drive profits because revenue growth is starting to slow down. Revenue growth is starting to slow down a little bit. So this year is the 3 Ps, but currently, you guys talked about it, Josh and Julie, it's about bond yields, the dollar, and now oil. Oil's kind of in this stealth rally now, up to $74 a barrel. that probably is going to dominate the first quarter of this year, we would say.
So a lot there to consider, but let's talk policy first of all, because that's sort of maybe most immediate with the latest tariff headlines back and forth. How is that going to affect your investment philosophy as you head throughout the year?
What's interesting about tariff policy, that's what we're kind of talking about, usually it helps small and mid caps. It's not doing that right now.
Right.
That was 8 years ago, before the Mag 7. So it's not doing that right now. But that's the first thing at our shop we used to think about. So now we think about more industries, and that's where the confusion comes in today. Is it going to be broad-based? Is it going to be targeted? One group says one thing, one group says another thing. So it's hard. I think the market, you can see that through the Dow this afternoon. What y'all talked about is having a tough time too.
And so, what do you do about it, though, John? As a market pro, as a CIO, your clients are asking, I'm sure, and you simply right now there is conflicting headlines and all this uncertainty about tariffs, taxes, regulation, immigration. How do you try to think through that?
So, first thing we think about is those profits, earnings season. So what's leading us to a bias of stocks over bonds right now is earnings season. And what earnings are expected to do this year, S&P 500 accelerate from last year. Earnings growth accelerate. So now the focus becomes earnings season. Are we going to get that 400 to 500 basis point beat in earnings from estimates? So that's the first thing. Second thing that's probably going to have longer legs this year is the concept of income. Income now may be able to smooth out volatility more than it has the last 10, 15 years. Because now I'm getting income from all three groups. I'm getting it from cash, I'm getting it from bonds, and I can get it from stocks if I want to diversify away from the Mag 7. So concept of income may be very helpful to investors this year.
And how should they incorporate that when they're thinking about income? In other words, they can diversify and still get income? Is that the message?
Yeah, so it depends on what kind of investor I am. If I'm accumulating, so I'm still accumulating my personal balance sheet, 4% doesn't mean a lot to me. But if I'm distributing, if I'm on that side of my personal balance sheet, 4% now means a lot to me because it used to be 0 a couple years ago. So it depends on where you are, your focus on income. But in our business, we've been missing 2 legs to the investment chair for 15 years, cash and bonds, and they're back. And we have to take that into consideration, obviously expecting somebody's outcome intent of their investment accounts.
Let me ask you, we talk a lot recently, you've heard all about the Santa Claus rally. Now we're talking about the January barometer. I mean, I get it, it's fun,
right.
There's some history there. I'm actually just curious, as a true pro, as a CIO, does that register to you? How much attention do you pay to those things?
What we're paying attention to right now, what our equity team is, did the rotation, and you guys talked about this, did the rotation already take place in December? And now are we starting anew? For instance, as you guys talked about the tech stocks moving today. So it was the last 2 years, the rotation's been in January, and it's been violent. Did it already take place? That's what our equity teams, so that's the first thing on our mind. Then the second thing on our mind is not so much the Santa Claus rally, that came from Yale Hirsch years ago, but now what's earnings season going to do? That's the focus. Our earnings growth, S&P 500, go from 10% last year to 13, 14% this year. That we'll start to get clues to that middle of this month.
And then you talked about productivity at the beginning as one of the 3 Ps too, and I know you're watching sort of the Fed and rates very carefully, and productivity feeds into that. Productivity, we've already seen some gains here. So how do we still squeeze out more in 2025? Do you expect that to continue?
That's where AI comes in, right? Is AI going to make the industrial sector more
Supposed to be
productive, et cetera?
Do you see, John, when you talk about, do you already see effects of AI in that way in boosting productivity growth?
Only in the margins, the legal business, the marketing business, in the margins. It hasn't, in our view, it hasn't come in mainstream yet. But what we're watching, every quarter a productivity number comes out. It's been above 2%. Is it going to stay above 2%? We think that, our economic team thinks that's important to profits. That's how you're going to turn 5% profit growth, or excuse me, revenue growth into 14% earnings growth this year. It's the only way to do it.
And what do you think happens to the yield curve in 2025? I know you're watching that as well. And then sort of what hinges on that for you when it comes back to the other discussions we've been having, whether it's, what happens with profits, et cetera?
No, you're totally right on. So theoretically, in a perfect world, the Fed goes to 390, the 2-year kind of gravitates to 390. The last 30 years, the relationship between a 2-year Treasury and a 10-year Treasury has been 1%. So that would put a 10-year at about 490. We're at 460 today. So in our world, is the yield curve going to steepen? Then we become interested in bonds at 490. Stocks aren't going to like it, but we're going to watch now from 460 to 490. What's the yield curve do? Yield curve is going to be very important this year, just as it was last year when we went from inverted for 2.5 years to positive.
John, thanks for coming in.
Thanks for having us.
But we'll see you again, hopefully.
Thanks for having us.
John Augustine, Huntington Private Bank CIO. We're just getting started here on Market Domination. Coming up, chip stocks surging today as investors eye comments from the CES tech event this week. We're going to check in on the sector as well as a few other top trending tickers on the other side. Stick around, much more Market Domination still to come.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action.
And explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best, worst, and most viewed stocks of the session on Yahoo Finance's trending tickers page. Taking first look at chip stocks jumping after electronics company Foxconn reported record fourth quarter revenue. Nvidia's stock, in the meantime, is on pace for a record close. So Foxconn, formerly known as Han High Precision, reported 15% revenue growth for last quarter. They do make servers for Nvidia. They're the biggest maker of iPhones, the biggest assembler of iPhones. So that helped, but also it's consumer electronics show time. And so people are looking for big announcements for a lot of the big tech companies.
Yeah, and Nvidia CEO Jensen Huang speaking tonight at CES. What will the man have to say? Analysts at BofA take their best guess, Julie. They're telling clients Nvidia they think highlights opportunities in pipeline in robotics. I think we're going to get some news on gaming and maybe auto with potentially, they say, some new partnerships there as well.
Yeah, and those folks also at BofA, led by Vivek Arya over there, not just looking to NVIDIA, but they highlighted a couple of different things they're going to be looking at too. One, the comments from Wang tonight, then AMD giving a press conference as well, and there will be a Marvell fireside chat. So all of those, there's going to be a lot of news coming out, but Arya is saying that those three events in particular will be something to look at. What's interesting is what we've seen from chip makers broadly. If you look at the Philadelphia Semiconductor Index, it rose 19% last year, but it's pulled back 9% or so from the record high where it was in July. So semiconductor makers, the latter half of the year, maybe Nvidia accepted, they didn't have collectively a hugely strong year. So
and
maybe
important
this will
because the strategists always remind us chips do tend to lead the market on the way up and on the way down.
Yeah.
All right, meanwhile, Plug Power shares jump amid positive final ruling for the production tax credit of clean hydrogen. This one's interesting, Julie. So Plug Power, you saw it move higher again today. Look at that, almost 20%. Still down, by the way, over the past 12 months, but it also spiked on Friday. And these were over these headlines that the Biden administration loosening rules around a tax credit for hydrogen production, and you see some big moves, not just in this name, but others as well, really moving off those names.
It feels like today we're seeing a little bit of a continuation of some of the stories from late last week, as though maybe people weren't in yet last week, and now they're coming in today and they're saying, oh, look at this thing I missed from Plug Power.
Right.
I'm still going to get in on the shares. But as you know, I always like to look at short interest when we're talking about a move like this in a stock like this. And indeed, if you look at Plug Power, the short interest is around 24% of float, which is pretty high here. However, it has trended down. So here's a chart of Plug Power stock price, that's in white, versus the short interest as a percentage of float. As you can see, again, it has come down as the stock has come down, and maybe people cashed out their shorts when the stock came down, but still 24% is pretty high. So this could also be something of a short squeeze as we see these big moves.
Yeah, maybe to your point, not a ton of excitement on the street with this name. I mean, most analysts who are paid to tell you what to do with it are still on the sidelines here.
All right, here's another one we're watching. It is Lucid. Those shares are rising as the EV maker reported upbeat production and delivery numbers. Yahoo Finance's Prasubramanian joining us here to discuss here. So how did Lucid do and what was driving the numbers?
So a decent quarter here for production and delivery. Produced around 3,400 Lucid Air sedans, which is a record for them, and around 9,000 produced for the year, which is matching their earlier guidance. They're no longer doing guidance anymore, but 9,000 was their number for production. So they hit those numbers. And this, as the Gravity SUV is ramping up and going to come out next year, big year for them. They need that SUV is projected to have something like 5,000 or 5 times the amount of sales as a sedan. So good news there for them. The stock on $3.50, I believe, right now, and it hit lows of $2 at some point. I'm concerned that the companies are still burning too much cash, not making enough cars. But if you look at the sales data, sales growth trends, they're growing faster than Tesla here, just a little bit. Rivian growing tremendously, actually. They're catering to these higher end buyers who are into these nicer sedans, nicer SUVs. So we're tapping into that. The question is, like I said before, is can they keep absorbing these losses on a so-called path to profitability?
What if we did get rid of that EV purchase tax credit? What would that mean for a name like Lucid?
So CEO Peter Rawlinson of Lucid said that it wouldn't matter much to them. They don't necessarily need it that badly because their cars are generally more above $80,000, which is the actual limit. So they're not necessarily tied to it, but leases are tied to that. I think that's a big deal. And I think maybe he's downplaying that a little bit. So I think any little bit can help with them on the margins, especially when it's not their money being incentivizing the products.
Another quick question for you. So you said, what's the average price point we're talking for a Lucid is what, 80,000 you just said?
For the Lucid Gravity will start at around $80,000,
Okay.
but the sedans are upwards of much more, usually around 100,000-ish. But you can get one for 78 supposedly.
So, and you said they sold around 9,000 for the year?
Produced around 9,000.
Produced around 9,000. So, like, who does that put is that other luxury cars at that price point? Who is it, like, who would they be comparable to, and how are they doing production-wise compared to those others?
So this car would be lining up against the Tesla Model S. That's basically the mark that it's actually kind of the benchmark, if you will. Porsche Taycans, those are also the sedans, super sedans at that level, 100 grand and above. Those are the kind of cars we're talking about. These are cars that are, in general, have limited audiences, right? And sales are going to be limited because they're expensive. They're not SUVs, so they're not as utilitarian as a bigger truck would be. So that's what you're kind of talking about. It's enthusiasts, people who want the luxury, the nicer materials. And Lucid does have very good tech, and they've white labeled their technology to Aston Martin among some brands. So that's what's sort of driving the story for them is white labeling, Saudi backing, and potential growth in Europe and also in Saudi Arabia too.
I see them rolling around suburban New Jersey, Praz. Maybe I just noticed them because it's a slick-looking car.
And they're big in California too. So we'll see.
Interesting stuff. All right, thanks, Praz. Appreciate it. Well, sticking with what's going on in the EV space, aides from President-elect Donald Trump's team are exploring tariff plans that would only focus on certain sectors. That was according to a report by the Washington Post. While investors prepare for Trump's second term, many are wondering how potential tariffs could impact Tesla stock in 2025. For more, we're bringing in Stephen Gengaro, next-gen transport analyst at Stifel. We should mention that President-elect Trump has said, no, that's not the approach we're taking. So, things are as clear as ever when it comes to what we're expecting for tariffs. So, Stephen, when you're looking at how to model it for a company like Tesla, what are you thinking? What models are you using? Are you having to just consider a wide range of scenarios?
Yeah, good afternoon. Thanks for having me. So it's a very good question, right? As we try to sort of gauge the impact of tariffs, it's wide ranging, right? I mean, in some cases, it limits competition in the U.S. market. So if you're manufacturing cars in the U.S. like Tesla, it's theoretically a positive. And then there's the supply chain portion of it where you have to think about, because you're getting a lot of parts from areas outside the U.S. market. So there's definitely a lot of moving pieces. And so when we think about the tariff side, we try to account for it in the model very, very loosely, honestly, at this point. And then we basically adapt as we get more information on how things will ultimately flow out from the Trump administration.
I'm curious, Steve, we've had some of your colleagues on the street come on, and they're very bullish on Tesla. And part of their thesis, Steve, is that, in their words, Musk bet on Trump, and he bet right, and this is now going to mean good things for Tesla. It's going to mean, hey, Trump's going to speed up, he's going to accelerate autonomous driving. Is that part of your thesis, Steve? And if so, what specifically, in terms of regulatory policy, do you think would be impacted?
Yeah, so I think to start, and we get the question a lot about Tesla, like, is it more than a car company? And I think the short answer is yes, right? If you're buying a stock simply because they're selling EVs, the stock's overvalued. When you start thinking about the full self-driving initiatives and you start thinking about how that plays into the cybercab business over time, that's really a huge value driver for the stock in the medium to long term. And that's kind of how we think about the valuation, is sort of discounting back, the potential from those businesses. When we think about the regulatory environment, right now we have, sort of supervised self-driving. If you ever tried it on a Tesla, you basically take your hands off the wheel, the car basically yells at you, right? And getting to that sort of unsupervised level of self-driving, which is really the catalyst to get to these other product lines, it's going to take some time, right? And I think right now you're really focused on California as one of the main markets. Elon Musk has talked about having some sort of fully self-driving vehicles in Texas during 2025. So it's really niche from a market perspective now. As far as sort of betting on, Musk betting on Trump, I think he's clearly engaged in the conversation as far as getting, sort of regulations accelerated on the FSD side, and that sort of opens the door for just various growth opportunities for the company over time.
Steve, what is the risk inherent with that? In other words, obviously Musk would like to have actual full self-driving on the road as soon as possible. Is there a risk that with the regulatory forces aligned in his favor, that it gets to market before it's actually ready?
Yeah, there's actually two big, I think, points of debate here, and I think you hit on one exactly. And it's, if there's an auto accident on my way home today, and there's an accident on the side of the road, nobody hears about it, right? If it's an accident with a full self-driving Tesla, you can bet it's basically on every news source across the country saying, a self-driving Tesla got in an accident. So the reaction to a problem is going to be obviously exacerbated. I do think you're right, though. I think you have to be a little bit careful about getting, the capabilities to the point where they're at least as safe, if not probably safer than humans driving the car before you get it to roll out aggressively. I think that will honestly be part of the regulatory environment as it unfolds. The other part of this is the Tesla AI-based, camera-based, AI-based system for FSD the answer. There's certainly experts out there who think you need some type of LiDAR as part of the process, like a Waymo has. We think the AI camera-based system does work, but that's the other debate here, and probably the other risk, sort of the Tesla story, is their FSD system ultimately going to be successful? And we think it will be, but that is a point of sort of risk to keep in mind.
More sort of near intermediate term, Steve, that relatively lower cost EV, we expect that when, Steve? Is that mid-year? What would you be looking in terms of price point there? And what do you think that's going to mean for just the overall trajectory of the EV business?
Yeah, and last week they sort of slightly missed on their deliveries for the fourth quarter. They slightly missed on their kind of target of modest 24 growth over 23. And the rollout of what we still call the Model 2 in our model, but the rollout of that during 2026 is I think really what's behind their expectations. You get 20 to 30% vehicle growth in 2025 versus 2026. We're pretty careful about the vehicle growth numbers in 25 relative to what they've put out. We're at the lower end of that 20 to 30% range, but that vehicle should start to roll off the production lines during 2025.
Steve, great to see you on the show today. Thanks so much for joining us.
Yeah, thank you.
Coming up, could a stock market correction be on tap for 2025? We're going to speak to a strategist on the other side about a big risk investors may be forgetting about. Stick around, much more market domination still to come.
Our next guest believes the stock market correction could be sparked by something investors aren't thinking too much about right now, a recession. Joining us now, Jim Paulson, Paulson Perspectives blogger and veteran strategist. Jim, it's good to see you. Now, to be clear, you don't think a recession is necessarily in the cards, but the fact that people seem to be discounting it almost entirely, well, maybe that's going to change this year. Is that fair to say?
Yeah, I think that, I think recession fears have been really strong, as you know, Julie, since the pandemic, and they've kind of finally faded away. In fact, the Fed and the bond market now seem to be concerned a little bit about inflation creeping up and maybe the economy growing too much, so much so that the Fed has, sort of slowed down its easing campaign. But I think recession fears lie there just under the surface yet, and it wouldn't take a slowdown here to reignite those fears. We've already seen a sizable decline in economic surprise index coming down. More importantly, I think that the policies of late, while everybody's focused on the Fed easing, much of the other policies are tightening. Since the Fed's eased in September, the 10-year bond yield's gone up by a full percentage point. The real value of the trade-weighted dollar index is up by about 8%, 6 to 8% over that same period of time. Money growth in this country, M2 money growth is growing 3.7% year on year. That's below the level of nominal GDP growth of 5%, which is just simply insufficient to maintain that growth rate. When I go back to 1960, when money growth is less than nominal GDP, real GDP growth declines in the coming year. So I wouldn't be at all surprised if real GDP is slowing down to about 2% here in 2025. Maybe even falls a little below that. And I think that's going to reignite some recession fears. One more point. People have already been worried about the unemployment rate. It's risen almost 1% from its lows in this cycle, which is odd. And just imagine it, I think it's 4.2. Imagine if that ticks up here at some point by 4.3 or 4.4, I could see where people get really nervous. And if we have a reignition of those, I could see some selling being brought to the stock market, including the tech stock.
And Jim, if that happens, so, recession fears reignite, investors get spooked, market corrects, maybe it's 10, maybe it's 15%. Would that be a buying opportunity, Jim?
I think it would be, Josh. I still think we're in a secular bull that could last a few more years. And we just haven't had, we haven't had a correction maybe in almost a year and a half. And I think we're due for one. And I got kind of a catalyst here that could bring one. And I think it'd be a great buying opportunity. I wouldn't bet a lot on this because I think we're still in a bull market. I wouldn't raise a lot of cash. I don't think it's going to be fair. But I might be tempted to move a little from some of my more aggressive investments to some defense for a little while. And if you get a correction, then you got some funds that you could put back to work at much cheaper prices on those aggressive names.
Would defense be the bond market, for example, or would you, I know that you think bond yields right now are sort of out of whack, right? If you look at various historical indicators of bond yields, and it seems like some of them are kind of broken compared to what you do see historically.
I agree, Julie. We've got a pretty good rise in the labor unemployment rate. The factory utilization rate's coming down in this country, and that's been going on now for the last 1.5, 2 years, and yet bond yields continue to go higher as our resource markets become more unemployed. That's just one example. Commodity prices are down 33% from where their highs were in 2022. Over that same time period, the 10-year yield's gone from under 3% to 4.6. The inflation rate's dropped from 9.1 to 2.7, and then 10-year yield's gone up. Those are rare things to have happen historically. Normally, interest rates sort of follow those trends lower. So I do think rates are too high, and I agree, if we get recession fears, I think there'll be a run to the 10-year Treasury. I think those rates will come down. I think the Fed, it'll open up the floodgate for the Fed to ease more aggressively. I think money supply will go up. I think the dollar will come off, and that's what could create a pretty good rally after this correction that still gives us a decent return on the overall year. I would prefer to go to defensive stock sectors and the interim than bonds. I think bonds might do pretty well if we have recession fears, but I think the stock market might ultimately do better on the balance of the year.
In terms of why yields have moved higher, Jim, we've asked some strategists, is it, economy's resilient, inflation sticky, is it investors worried about fiscal challenges? Some have argued to us on the show it's actually all three of those. Is that your opinion?
Yeah, I think it's a little bit pickup in some of the inflation measures. I mean, the CPI annual has gone from 2.4 at its low to 2.7 in the last couple of months, for example. Commodity prices have lifted off their lows a little bit. So there's some concern there. Boy, that pandemic, Josh, it really created the 1970s inflation ghost again in the culture. And I don't think we're anything close to having an inflation problem like we did then, but some people still fear that. And then I do think people think it's bond vigilantes that are objecting to chronically large federal deficits and huge amounts of federal debt to GDP ratios in peacetime and taking that in their own control. There might be some of that going on. I haven't really seen that work historically that often. And I'll tell you what, even if that is at work today, if you put recession back into the minds of investors, that will eliminate the need to raise rates.
Jim, always good to see you and have you on the show. Thank you, sir.
Thanks for having me very much.
All right, let's get now to some calls of the day here. Wedbush, start there, upgrading Shopify from neutral to outperform. This is Scott Devitt over at Wedbush, friend of the show, Julie. Scott's a very smart guy. Upgrade Shopify to outperform, saying, and here's really the key line for his client. It says, we are more constructive on shares in the near term, given he talks about an improving margin outlook following Q3 results. Also says expectations for strong operating income growth in 2025.
Yeah, and they raised the estimates for the company. They said their revenue and operating income estimates are going higher. Price target going to 125 from 115. They call Shopify the dominant e-commerce software player. It's got large TAM opportunity. He says considerable pricing power within its subscription services as well. This is part of a bigger consumer internet outlook that they put out, and this is one of the top picks within that outlook.
Yeah, stock's had a nice run already. I'm just looking here. It's up about nearly 50% in the past 12 months, but Scott says it goes higher.
Yep. All right, let's get to Lyft as well. Benchmark upgrading that stock from hold to buy. The note they're citing significant optionality here. Analyst Daniel Kurnos saying that the company's domestic focus, quote, and lower share means they both have less risk in North America and everything to play for globally. But, they haven't played much globally, so we'll see what happens on that front.
Yeah, it does note that Lyft and Uber, they say, likely to face ongoing pressure from Tesla and Waymo on the autonomous vehicle front. Price target looks like 20, which would be a nice size pop from here. Stock, to your point, it hasn't done a whole lot over the past 12 months. Most analysts still on the sidelines, but Benchmark is a believer.
Yes.
All right, finally, RBC Capital Markets. They downgrade T-Mobile from outperform to sector perform. This one, Julie, interesting. Fundamentals, they look fine. They look intact. Valuation, though, they say not so great. It appears full. They say we've updated our valuation model to reflect the higher interest rate environment. They say, listen, we incorporate some minor tweaks to our estimates. And bottom line, we're taking this one down to sector perform. Although execution appears solid, they told clients, we see less favorable reward risk based on current valuation and what we view as stronger prospects elsewhere.
When we have our discussions that remain sort of frequently high level, frequently, we talk about the economy, when we talk about higher interest rates and this higher for longer idea and the effect that will have, I gotta admit, I don't think of T-Mobile off the top of my head. So it's interesting to see that highlighted, presumably both because of what their customers are experiencing, debt load for the company, et cetera. Those higher interest rates, they do bite some companies.
Pack a punch.
Yeah.
All right, in a surprising deal announced Monday, Disney set to combine its Hulu Live TV platform with Fubo, the streaming service known for its extensive sports coverage. And the merger means YouTube TV, with over 8 million subscribers, now has some very real competition, as Hulu Live TV and Fubo will have a combined 6.2 million subscribers. Joining us now to talk about all this, Michael Pachter, Wedbush Securities Managing Director, Equity Research. Michael, always good to see you. So let's just start with that headline, Michael. So Disney making news, combining Hulu Plus Live TV with Fubo. Fubo surges. High level, Michael, what do you make of this deal? Does it make sense to you financially and strategically?
It does. I mean, it's very similar to T-Mobile merging with Sprint, to become a very strong number three. That's what these guys are going to be. So we've got Sling TV and YouTube TV ahead of them, and they're a close third. And the market's really going to be those three guys. I think that, in the future, your children are going to be cord nevers. My kids are going to be cord nevers. They're going to leave the house and they're not going to subscribe to cable TV. And our parents are going to, and our grandparents are going to pass away. So, ultimately, I think you get 2 to 3 million households of growth in over-the-top television. And I think it's really good to be the number three player with probably the best content of the three. Sling has virtually nothing, and YouTube TV has little. But Hulu and Disney are very powerful, and I think this is a great combination.
What about brand here, Michael? Because, you talking about the cord nevers, right? I think about my own kids, and listen, I'm not paying for YouTube TV for them yet, but that is the platform that they are most comfortable with, that they are native to, right? So how does that then stack up against a Fubo?
Yeah, and I'm really not talking about kids as kids. I'm talking about kids when they become adults. Right. So, they're growing up really not watching broadcasts. They just don't watch television by appointment. If you remember back when you were a little kid, DVRs didn't exist. So there was no such thing as on demand. Now everything's on demand all the time. And the only content that really hooks people is either sporting live broadcast or entertainment live broadcasts like the Golden Globes or the Emmys or perhaps WWE, where people really want to find out the outcome real time. So the over-the-top services are the solution to the consumer who wants a little bit of both. And, we just don't want to pay $200, $300 a month for DirecTV if we can get away with paying under $100 for Fubo, Hulu, and Disney.
Does this combo here, Disney and Fubo making this news, does it, in your opinion, meaningfully change the competitive landscape in any way? Does it mean Disney is, a smarter, better competitor in a better competitive position with YouTube, for example?
Yeah, with respect to the team at Hulu and the team at Disney, the Fubo guys are pretty smart and pretty scrappy. I'm really encouraged that the Fubo guys are in charge of this combined enterprise. They have had to kind of survive in an environment where they were outgunned, outmanned, outcapitalized, and now they're getting a big balance sheet behind them. They're getting to cash net positive, which is good, and EBITDA positive. So they're suddenly financially, they have no issues and they can move forward. I think the brands, I agree that, the YouTube brand is pretty powerful, but Hulu and Disney and ESPN are more powerful. So I frankly think that they can segment this offering. They can offer Fubo Lite, which is maybe just soccer in Latin America. You can get something that you want. If you can get the a la carte sports offering so that if you care about European soccer, you can get Bundesliga games or La Liga games in addition to Premier League, that's pretty powerful. So I think you're going to get all that, and you're going to see more original content migrating over to Disney Plus and Hulu as it has been for the last 5 or 6 years. So consumers are going to say cable's just not worth it, cut the cord or cord never, and move on. And I think these guys have the most competitive offering.
Michael, a lot of folks have been talking about 2025 as the year that we're going to get many more media deals. Deals generally, but media deals in particular. And here we are, January 6th, and we're already getting a pretty significant and surprising one. Is this now, does this open the floodgates? Is this just the beginning?
Yeah, I mean, I was intrigued by Ann Telnay's resigning from the Washington Post because she published that cartoon that was critical of Bezos and Zuckerberg. But the truth is, Bezos and Zuckerberg are interested in courting Trump because they want to do deals. And Amazon and Meta have been pretty much blocked by the Biden FTC. That's going out the window in a couple of weeks. So yes, I think Meta makes perfect sense as an acquirer of this combined entity. And I think they would love to have it. They have so much data capability that if they could actually get our viewing habits and monetize that through advertising, they would crush it. And that's the kind of a deal I think could happen. It couldn't have happened under the Biden White House FTC with Lina Khan. It can happen under the Trump FTC.
Very interesting, thought-provoking, as usual. Thanks, Michael. Good to see you.
My pleasure. Thank you.
Coming up, will a second Trump term mean a turnaround performance for the energy sector in 2025? We'll talk to an analyst on the other side about just that. Stick around, much more market domination still to come.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action.
And explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
"2024 was a volatile year for the energy landscape, while 2025 may bring a new era of transformation as President-elect Trump readies to return to the White House. But before the change of leadership, President Biden has taken action to ban new offshore oil and gas drilling along most of the U.S. coastline, a move that could frustrate Trump's energy plans. Here with more on what is ahead for the energy ecosystem in 2025, we have Clear Street senior research analyst Tim Moore. Tim, it's good to see you. Let's start off there, Tim. President Biden making this move, ban new offshore oil and gas drilling in most U.S. coastal waters. What did you make of that headline, Tim? How could it possibly impact the energy sector?
That's a great question, and thanks for having me on. We're excited to be here. It's interesting because, this has been a 70-year-old Lands Act Protection Act, and we weren't surprised with this happening a couple of weeks before the inauguration. It could be irrevocable, or at least seem irrevocable at first. It would be tricky to reverse and override. It's not anyway impossible. They need congressional approval. But we just point out, look, that was 625 million acres of offshore drilling protection on the continental shelves. A lot of it's in the Eastern Gulf. It's in Florida, off of Florida, Georgia, South Carolina. In our view, even if Trump is able to kind of reverse or get to it, it won't really improve any production until at least 5 years. It takes that long to bring on new production. In the meantime, we're pretty excited about offshore drilling. We cover Tetra Technologies, which has a couple projects and wells being involved in there in the Gulf of Mexico. And, we think the Gulf of Mexico itself could keep offshore production pretty good for the next few years. So we don't actually expect much to be done anytime soon with new additions.
And Tim, when you look at the performance of traditional oil and gas stocks over the past year, haven't done so great as a group, right? And I was just looking at some research from Bank of America that showed that long-only funds are at historical underweights of energy to the S&P 500 benchmark. Does that change in 2025, and what's the catalyst for that change?
That's a good point. I mean, we actually expect oil and gas stocks to outperform this year, and we can go into catalysts, but there has been, as I mentioned, 2 years of underperformance. Some of that's natural gas prices going down, but they started to recover in October. It is a cyclical end market. Really strong years in 2022, 2021. There was a rotation in and out of that. But we do expect the Trump administration to relax the permitting rules. They remove a lot of red tape, we expect. That'll bring on some drilling on federal lands. It brings on some new drilling projects on lands. So we think that that'll start getting priced into stocks. And we actually expect the stocks to start re-rating this summer. And we also want to emphasize the Trump administration has come out with rhetoric and statements that, they want to secure energy. They want the U.S. to be the leader in production and development of oil and gas in the whole world. We think that's going to help LNG exports. And we also think, it could be a pretty good year for oil and gas stocks.
Tim, switching gears, another theme I want your take on, solar. How do you see that theme playing out in 2025, Tim, and what in your way would be a smart way for investors to play it?
Well, thanks for asking for that. We cover 2 solar stocks, and they've actually done pretty well in the last few weeks. We cover Sunrun, and we put out a report on that on Friday. We think that that's one of our top picks in the clean energy sector. We recommend investors getting into that. They're the #1 leader in residential solar installations and battery storage deployments. They have something like 18% market share of the industry and 50% market share almost of subscriptions. We think that's a good stock to play. We also cover Altus Power, which you were talking about in your show a couple weeks ago when there were some takeover rumors mentioned for that. We think that solar is the best positioned clean energy play in terms of end markets. We like it better than wind. We like it better than hydropower. 6 to 7% of houses in the U.S. have residential solar. We think that can go to 20% over time. You look at Australia, it's a third of theirs, households that have it installed. It's very good economics. The cost to install this and the systems are down 50% in the last decade. It's more affordable. And we think that the U.S. really needs to pivot more towards solar, and that'll be the winner, we think, of all the clean energy transition markets.
What effect does the incoming administration have on that?
It's a very good question. It's been an overhang on the solar stocks since the morning after Trump won the election. There's an overhang of what's known as the Inflation Reduction Act, which I'm sure you've talked about, the IRA. There's some investment tax credits that have been very helpful to help solar adoption and penetration. Those could be either reduced slightly by the new administration, or they could move out to sunsetting years. A lot of those don't sunset or expire into 2032, 2033. So those could move up a few years. We think the Trump administration will do some type of reconciliation with their tax cuts, and it'll be more of a scalpel approach rather than just removing and completely annihilating the IRA. We just want to remind investors that about 2/3 of the IRA funding for these projects have been in Republican areas, and they create jobs. So we don't think it'll get completely pulled away. We just think it'll be some fine tuning. And some of the companies are getting smart ahead of that. We put out a report on Sunrun. We think they're going to do a safe harbor invokement, which lets them, sign up a deal like they did. They announced today with Solar Edge to do, buy forward 5% of their project costs. So that could help them buy up to 4 years of protecting some of these tax credits. We'll see how that plays out. We don't know if that'll get put into effect, but that is a possible workaround.
Tim, great to have you on the show today. Thank you for joining us. Appreciating those picks.
Thanks a lot. Happy New Year.
You too. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime. Let's take a look at the major averages here to see where they ended the session. As we looked an hour ago, we were seeing them trend lower, and still pretty much on the same trajectory here. The Nasdaq, the big winner of the day, up 1.25%. As we talked about, seeing a lot of strength among the semiconductor makers. Nvidia closing at a new record as we await comments from CEO Jensen Huang at the Consumer Electronics Show, or CES. Is it even formally known as the Consumer Electronics Show anymore? Is it just CES? Whatever it is, he's talking there tonight, and there's a lot of anticipation of his comments. But as you saw, a little wand performance from the Dow today, and the S&P kind of hovering in the middle.
That's a good way to put it. I like that, Juan.
Thank you.
A Juan performance. This next chat isn't going to be Juan.
No,
I'll tell you
definitely
that
not.
much. Tech stocks leading the way on Wall Street, and investors are gearing up for a big year ahead. And our next guest has a look at the top themes you need to watch in 2025. Joining us now is Amanda Agati, PNC Asset Management Group CIO. Amanda, great to see you. So let's talk about these big themes, Amanda, for 2025. There are a few of them you highlight. One of them you talk about, fiscal policy uncertainty. We certainly saw that today, Amanda. The back and forth on tariffs, headlines that the Trump team was rethinking them. Trump says, hold on, not so fast. How are you, though, as a CIO, as a market strategist, Amanda, how are you thinking about fiscal policy uncertainty in 2025? What it could mean for the markets?
Well, first off, Happy New Year to you both. It's so nice to be kicking off my new year with you. We chose fiscal policy uncertainty as the number one most important theme for markets in 2025 because there is so much uncertainty. And so what have we been doing? We've been writing and rewriting our 2025 investment outlook, because every day that goes by seemingly creates some more information or perhaps even some more uncertainty about what policies might ultimately come to fruition. And I think the challenge for investors in 2025 is everybody has seemingly thought that the new administration will organize very quickly and execute upon all of its campaign themes very quickly. I think we've seen in the last few weeks and months, it's a little bit harder to get that done. And so there's some recalibration that's happening in the market right now around timing and implications and magnitude of these policy changes.
Well, and therefore, we also don't know the effect that we are going to see on deficits because we don't even know what the policies are going to be, right? And so, but I know that's a theme you're watching closely. So how do you then incorporate all of that into your strategy?
The deficits and debt level theme is basically a first for us in terms of incorporating it into the top 10 list. And it's really because historically, markets have largely shrugged off deficit spending and debt levels. Markets crave the sugar high from policy accommodation and more spending, at least on the equity side of the equation. Fixed income markets are really not very happy at all about what we're seeing in terms of current levels of deficits and debt and what is potentially being proposed for the new year. And so it's the first sign, material sign, I think, in our view, that you're seeing a market-based reaction and a negative one to deficits and debt levels. So it had to make the top 10 list. And I think the biggest thing that we're watching is as Fed policy loosens, we already are down 100 basis points on the policy rate. We've actually seen the 10-year move in almost a perfect inverse correlation. It's up 90 basis points over the same period of time. That's a Houston, we have a problem here scenario that the fixed income market is signaling.
And Amanda, what about valuation as well? Obviously, listen, we're always taught as investors, valuation is a bad timing tool. Interesting, though, from Torsten Slok over at Apollo, Amanda, today to his clients, Torsten always puts out these interesting charts and tidbits, and Torsten pointing out, emphasizing the price to book ratio, Torsten saying, for the S&P 500 is at record high levels here at this point. So I am curious how you're thinking about the valuation challenge.
Well, we don't spend a ton of time looking at price to book broadly for the market. That's a much more nuanced valuation metric that I think is relevant for certain subsectors and industries in the market. But when we just simply look at forward PE, it's going to be a key governor in terms of how far the market can advance in the new year. If you look at the S&P 500, top 7 or top 10 names trading at a forward PE in excess of 34 times, not cheap. But the rest of the market, the bottom 490, 493 are trading around 20 times a forward PE. Also not cheap. And so, last year's returns really were driven largely by valuation multiple expansion. We don't think that's the story for this year. We think it's much more about the path for earnings growth. So it can still be a very positive year, but we think it's largely going to be somewhere in the 10 to 11 or even 13% range in total, just because we're not going to get those valuation tailwinds.
Well, and how should we be thinking about, sort of active versus passive, or whether to buy an index versus whether to buy stocks? Because I know you're looking at correlations. I saw a recent note from Bank of America where they're looking at the breadth that we saw in December that actually hit an all-time low in terms of the percentage of the stocks in the S&P 500 that were outperforming the index. Not a lot was the answer. And so what does that imply about how investors should be thinking about that sort of active versus passive question for this year?
Yeah, these last couple of years in particular have been really, really challenging for active managers. Really, and looking back on it, investors were by far best suited to just having broad-based beta market exposure, low cost, cheap, passive exposure when the market is so rapidly rising. We think 2025 is going to be a different dynamic. We think it is going to be a return to active management, adding value again, but it's really going to be very much contingent on a reversal of some of these correlations. So, it has been a very low correlation environment, but as you said, it's a function of the top 7 or 10 names. Everybody else is kind of like stagnating from a price movement perspective. And so we do think that as earnings growth starts to broaden out and as monetary policy loosens a bit further, maybe not quite as much as what investors would like, but loosen a bit further in 2025, that will create more distinction between winners and losers and a better backdrop for active.
Amanda, also big theme in 2024, of course, was that mega AI trend. Lots of excitement, lots of interest. As we look at 2025, I'm just curious how you think about the AI trend and theme evolving, Amanda. You think is it going to be easy? You just stick with what worked in 2024, or no, it evolves, it develops, and investors are going to have to shift with it?
I think at some point investors do need to evolve and shift here. It can't be all about one stock, Nvidia, as it has been the last couple of years. And so we really think that there's going to be a broader kind of adoption and development of use cases across the market, across sectors, well beyond technology. We may not feel the full effects of it in 2025, but I do think towards the back half of the year, we will start to see some of these use cases materialize in a broader based way. And that means there are greater investment opportunities in the world of AI beyond just that one stock. I think what's most critical, though, is not about Nvidia or picking any other stock in particular. It's about the productivity enhancement that can come from broader based adoption here. We're past the peak in terms of operating margins on the market. And so it could be a really nice uplift in the second half of 2025.
So a really nice uplift because we'll see expanding margins as a result, or will we not hit that sort of delta yet because the stuff's also expensive? I don't know. I mean, I don't know what the one-to-one is between AI tech versus humans, right? But the upfront costs seem pretty high.
The upfront costs are big, and CapEx is going to continue to be an important theme around this in 2025. But, we've been at this for a while now, right? This is not just the first year of AI-related development and use cases, but we do think by the time we get to the second half of this year that we are going to start to see some modest uplift in margins. It doesn't solve things. It doesn't save the day in terms of operating margin expansion and potential. But at a time where pricing power in general is starting to wane, given all of what we've been through and endured as consumers, and in this inflationary backdrop, it could be a very welcome, if modest, tailwind in the back half of this year, with sort of an acceleration and ramp into 26.
Amanda, thanks so much. Appreciate it.
Thank you.
Well, mixed signals are surfacing over President-elect Donald Trump's tariff plans as the presidential inauguration nears. We're taking a closer look at the whiplash over Trump's tariffs with Yahoo Finance's Ben Werschel. And the whiplash we're discussing, Ben, is that there's a report in the Washington Post today that, well, maybe there wouldn't be the kind of tariffs on China we're talking about. Maybe there would be universal geographic tariffs, but only on certain areas. But then Trump said, no, that's not the case. Well, I'm already tired. It's not even January 20th.
Exactly.
Then.
It's the tariff roller coaster is back. Anyone who remembers 2017 and 2018 will remember that as well. Yeah, we had about 3 hours of what you could call business world elation that maybe Trump's hard edges would be sanded down, but he made very clear in a post at 9:15 that Washington Post story in his view they would not be pared back, and that story was wrong. So it led to a little bit of volatility in the markets. We saw the dollar sort of of the dollar index go down and then go back up on these up and downs. And we sort of end the day a bit where we began, but sort of two takeaways for you, Julie, on kind of what this means going forward. The first is about Trump and his staff. This is a truism of Trump that often the president-elect sounds very different than the people that work for him. And I think we're seeing that very much today. The Washington Post story was openly, it was about conversations among folks like the incoming Treasury Secretary Stock Bessent, other figures like that, about making a plan for this, and then which Trump was clearly not on board with. And then the second takeaway here is there is a real unforgiving math, no matter how much rhetoric we hear around tariffs about this. Trump, what makes this so naughty for Trump is that he's also promising his tariffs are going to pay for everything else. Just on Sunday, he talked about paying for all his tax cuts with tariffs and more. The math here is that the U.S. brought in about $77 billion in tariffs last year, based on Trump's tariffs before. The tax cuts alone would cost $300 billion, somewhere in the neighborhood of $300 billion a year alone. And the tax foundation has already said that if Trump really wanted to do this, he'd have to implement tariffs that are bigger than what he campaigned on, which were pretty eye-popping tariffs. So it sets up this dynamic here where Trump is clearly, all the reporting I've done and a lot of others have done, is that Trump himself wants to go big on tariffs, and he's determined to go big on tariffs. And what he's not interested in is letting political pressure or the court challenges or even his own staff stop him. Whether they can remains to be seen.
All right, the headline and the dramas continue. Ben, thank you so much.
Sure.
Appreciate it. Coming up, with President-elect Donald Trump set to retake the White House in 2 weeks, how will he handle the deal between U.S. Steel and Nippon Steel? Stick around, more market domination overtime coming up. On Friday, President Biden blocked a $14 billion deal between U.S. Steel and Nippon Steel, but all he really did was make it the next guy's problem. Joining us now is Yahoo Finance's Rick Newman. Rick.
Hey guys, so the news today obviously is that both of these companies have filed 2 lawsuits trying to make this merger go forward. One is basically trying to overturn Biden's order that prevents this merger on national security grounds. And then there's another lawsuit that's a racketeering lawsuit alleging that the Steelworkers Union colluded with Cleveland Cliffs, another steelmaker that wants to buy U.S. steel cheaper than Nippon Steel does. They tried to block that, the Nippon deal, according to this lawsuit. This is a pretty weird circumstance. I mean, I'm not aware of another instance where a president blocked some kind of purchase or merger for national security grounds, and there was a lawsuit. So I don't think anybody knows if this might actually be overturned in the courts. But it also does, it positions U.S. Steel as if they sort of still have this Nippon offer while they figure out what else to do. So what is U.S. Steel going to do? I mean, most analysts are saying U.S. Steel is not in such bad shape that it's going to declare bankruptcy or collapse. It can continue operating as a standalone company, less efficient than it would like to be, without the scale it would like to be. But that still leaves questions about these unionized facilities in Pennsylvania and Indiana. So what I think Donald Trump is going to do when he comes in is what he did before during his first term. He's probably going to impose tariffs on imported steel and aluminum, which would benefit domestic steel makers such as U.S. Steel. The problem with those tariffs is what they do is they essentially make domestically produced steel more expensive. So if you are a steel maker, that is good for profits, and we did see steelmaker profitability go up. But if you buy steel in the United States, think of automakers and appliance makers that pay for that steel, your profits go down. So it might help the steel industry and steel workers a little bit, and it would harm other industries that are purchasers of steel and those workers a little bit. And if that's Trump's whole approach, I'm not sure he's going to do much more for steel workers than Biden has done here, which is essentially just punt, as you said, Josh.
Well, Rick, not to go too far down the steel rabbit hole here, but there's also the complaints from the industry for years have also been about so-called dumping. That is, other countries, in their words, dumping artificially cheap steel into their home markets. And that's been something that we have seen prior administrations try to take actions on also. So you have to wonder, would it be just a tariff approach potentially, or would there be some other kind of measures that a Trump administration would take?
So when you think of dumping, mostly you think of Chinese products. Right. And there have actually been heavy tariffs on Chinese steel since the Obama administration. And we basically do not import we import hardly any Chinese steel. So it's not Chinese steel that is really the problem. It is Chinese products in other categories, which Trump is going to target. But when Trump imposed tariffs back in 2017 and 18 on steel and aluminum, it was on Europe, it was on Brazil, it was on South Korea, it was on countries that are basically allies and friends of the United States. And then if we remember what happened back then, those regions and countries introduced retaliatory tariffs on American products and American firms. So if you remember, Harley-Davidson got caught in the crossfire of this. In 2018, Europe imposed big tariffs on Harley-Davidson motorcycles that basically made those motorcycles too expensive to purchase in Europe. And that was a big problem for Harley-Davidson. So that's why this tariff playbook is just not real effective. Trump, I mean, as Ben Werschel was just saying, Trump now is acting like tariffs are the solution to everything. Whatever the problem is, fentanyl from China, or we need more budget revenue or something, Trump is like, let's just impose tariffs. Real world, it doesn't work that way. And tariffs always impose a cost someplace else. You're just moving the air around in the balloon, basically.
Well, we'll see what actually starts happening once we pass Inauguration Day, Rick. Thanks a lot. Appreciate it.
Bye, guys.
Well, last year, one index of developed markets rose by 17% compared to 7% from emerging markets. Well, looking ahead to 2025, the growth for emerging markets is facing a new layer of uncertainty as President-elect Donald Trump returns for a second term. Olga Bittel, William Blair global strategist, joins us now with more. Olga, we've been talking a lot about what could happen in this incoming administration, and the effect mostly on the U.S. is where our focus has been. But of course, there is a vast ripple effect around the globe. So investors who are interested in emerging markets, what do they need to pay attention to in terms of the incoming administration's fiscal policy?
Well, fiscal policy is going to be a tough one. In terms of what the incoming administration is likely to do, of course, there's a lot of debate and discussion. What emerging markets economies need to focus on, and have largely already done, are two things. What we really focus on here at William Blair in terms of thinking about emerging markets is the overall direction of the dollar vis-a-vis emerging markets currencies, and of course, dollar vis-a-vis the euro and the Japanese yen. So in an appreciating dollar environment, emerging market equities tend to struggle. In a depreciating dollar environment, emerging market equities tend to do quite well, as do other international equities. And then the second component underpinning the direction of the dollar more broadly, of course, is global growth. And this is where not just fiscal policy, but macroeconomic policy, and particularly volatility and the uncertainty that the incoming administration seems to want to embrace as a method of economic policymaking, may be detrimental to growth. But of course, there are plenty of growth opportunities, not just in the US, but around the world. And so the verdict on growth is very much out.
Olga, I want to get your take on some specific regions, countries. Start with China, Olga. We certainly have bulls come on this show, and they'll talk about relatively low valuations they'll highlight in their opinion. They'll talk about government stimulus, but I'm curious to get your thoughts.
Absolutely. So what's one of the things that is really underappreciated in our view about emerging markets is that this asset class and these countries specifically have come a long way, to the extent that many today control their economic destiny to a much greater extent than they have ever done before. And so in that sense, China is perhaps a prime example of that. So in the first Trump administration, they actually took the policies, the US policies, quite seriously, and went ahead with a full speed industrial, technological, economy-wide upgrading and moving up the value chain. And that process is already yielding pretty spectacular results. We're all familiar with their success in the auto market exports, in EVs specifically, electric vehicles, but this success is much broader than that. If you compare the 10 export industries in China in 2013 to 2023, there's hardly any overlap. What that suggests is that the economy the size of China's is able to move up the value chain pretty aggressively when the domestic policy is set up in the right way. More recently, we've seen India trying to do something similar. Of course, India has benefited from tremendous efficiency reforms from 2013 to 2015. And so that has created or freed up a lot of capital for consumption, to a lesser extent for infrastructure. We're starting to see the fruits of that. And of course, energy policies of this administration should not be underestimated. To the extent that the US is wanting to export more fossil fuel-based energy, the price of that fossil fuel energy is likely to then decrease in real terms. And that, of course, is going to be an unmitigated tailwind to many emerging markets, which are largely importers of energy and specifically fuel.
Are there particular emerging markets in 2025 that you think are going to break out, Olga, and be really a positive place for investors to be looking?
That's a great question. And of course, that largely, again, depends on what the administration will do. So one of the promises going into the election has been a swift resolution of the Russia-Ukraine conflict. Should we see a permanent or a semi-permanent ceasefire, the opportunity for reconstructing Ukraine and Russia are almost unlimited, certainly as far as 2025 is concerned, but probably for many, many years to come. on the infrastructure, on the physical infrastructure, digital infrastructure, consumer will come back. All sorts of exciting things will come back. And of course, the Eastern European economies are quite well positioned to drive that growth. They have the expertise of operating in that part of the world. They have the know-how. That's one exciting area. Another, of course, is Middle East. Notwithstanding the developments that we've seen in Syria, there are lots of other places. Hopefully, there will be a ceasefire or even a permanent cessation of hostilities. And the peace dividend that can accrue from that is tremendous. We're already seeing tremendous opportunities in Saudi Arabia. That equity market has really come to life from almost nothing. There are lots of IPOs, companies coming to market for foreign investment, for domestic investment opportunities. You can't forget things that are happening in Latin America. Brazil has endured its fair share of ups and downs last year, but it can't be discounted. And of course, there's Asia, the perennial source of all kinds of exciting opportunities on the consumer side, on the healthcare side, and the technology front.
Olga, great to have you on the show today. Thanks so much for joining us. Appreciate it.
Thank you. Bye-bye, guys.
Time now for what to watch Tuesday, January 7th, starting off on the labor market. It is a big week for jobs data. We're going to be kicking it off with the new job openings and labor turnover survey in the morning. Economists forecast that number to hold steady at 7.7 million on a month-over-month basis. The new data coming ahead of Friday's full jobs report.
Moving over to the Fed, we'll be getting more Fed commentary tomorrow morning from Richmond Fed President Tom Barkin. This comes after comments earlier today from Fed Governor Lisa Cook. She said that Fed officials can be more cautious with rate cuts. The Fed also seeing some shakeups today. Federal Reserve Vice Chair for Supervision Michael Barr plans to step down from that role, but will remain at the Fed. That will happen next month. So investors will listen closely to tomorrow's commentary for any signals on the Fed's next move.
And finally, some earnings coming in tomorrow. Cal-Maine Foods announcing results for its second quarter, and also keeping an eye on revenue with egg prices still high.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A mixed day for markets, with the Dow mostly flat, but the Nasdaq and S&P finishing higher. We're going to bring you today's market takeaways. And then America's in the midst of a housing crisis, and housing supply just hit a 4-year high. Good news, right? Not so fast. We'll explain coming up. Plus, Nvidia closes at a new record high. That's just ahead of CEO Jensen Huang's keynote address at CES. We're going to tell you what to expect from the speech tonight. Well, the total number of homes for sale in the U.S. climbed to the highest level since 2020 in November on a seasonally adjusted basis, rising 0.5% month over month and 12.1% year over year. While that might seem like great news, considering all the talk of America's housing shortage, it isn't quite that simple. Joining us now is Daryl Fairweather, Redfin chief economist. Good to see you, Daryl. So you got a new report out looking at our housing market, Daryl, and some good, interesting data on housing supply specifically. Walk us through what you're seeing.
Over half of homes have been sitting on the market for more than 60 days, and that's why we're seeing this increase in housing supply. It's not that, more people are listing. I mean, a bit more people are listing, but that's not the main driving factor. It's more that homes are accumulating on the market because those homes are hard to sell, probably because they're overpriced or there's something else that's turning off buyers.
How does this break down regionally, Daryl? Are there certain regions, states which have sort of higher levels of kind of what you might consider stale inventory than others?
The places that are bucking the trend are Seattle, San Francisco, some of those coastal places where incomes are really high and those homes are still moving off the market. People are willing to spend just so they can buy a home. In other parts of the country, it's taking a bit longer for those homes to move. There isn't as much strong demand.
So what happens next, Daryl? Would you expect to see price cuts now to try to start moving this inventory?
I think that's what's going to happen. Or those sellers are going to have to delist their homes. A lot of homeowners have record low mortgage rates, and they're not really willing to budge on price because they feel like it's not worth it for them to sell and then have to buy again if they're not getting a high enough price on the home that they currently have. So that stalemate is going to have to resolve somehow. Either they lower their price or they delist.
Daryl, you mentioned, there's still folks out there obviously sitting on those relatively low mortgage rates. I'm just looking at the 30-year fixed here, Daryl. According to Mortgage News Daily, we're back above 7. It's 7.1%. Where do you see that, Daryl, 6 months from now, 12 months from now?
My best forecast is that mortgage rates are going to stay flat. They will likely jump up and down as they do. Mortgage rates can be quite volatile, even on a daily basis. But there's nothing that we see that's going to bring mortgage rates down. If anything, there are some pressures up, like potential tariffs could put prices higher, making inflation more of a problem for the Fed, and the Fed would have to raise interest rates if inflation became a problem again. So there's not a lot of optimism right now for rates coming down. We could have a weaker economy, and then that would cause rates to come down. But I'm not rooting for a weaker economy.
So if they're going to stay around these levels, Daryl, that means what for existing home sales?
We think home sales will improve slightly in the new year simply because people have been waiting so long for rates to come down and they're tired of waiting. People need to move on with their lives. They need to move to a new part of town for a new job or get married or do whatever big life event comes with buying a home. And also homeowners, although they do have these low mortgage payments, their property taxes have gone up, their maintenance costs have gone up, and some of these homeowners just don't like their homes anymore and they want to move on and get on too.
It's interesting, Daryl, because, housing was front and center during the election, right? Harris talked about it, Trump talked about it. With this new incoming administration, do you expect to see any initiatives, any new policies from the new White House, maybe try to jumpstart supply?
Yes, Trump has touted that under his first term, mortgage rates were much lower, prices were lower, and he has promised that he will bring back that level of affordability. But it's going to be harder done than said. It's going to take a lot of policy, a lot of cutting of red tape to get more construction accomplished, zoning reform that needs to happen at the more local level. And that's going to take time. It might not be something that we see progress on in the new year, and it might not even happen until the end of his term.
And finally, Daryl, your thoughts on the rental market, what you're seeing now, what you see ahead, certainly front and center for the Fed. I'm just curious about the themes and how you see that market playing out over 2025.
Well, the rental market actually looks good for renters. It is a renter's market right now because rents are flat. So that's good news. It might bring some people out of the housing market, but at least they'll be able to afford their rent another year.
Daryl, always good to see you on the show. Thanks for joining us.
Excuse me.
The S&P 500 Nasdaq closing higher as chip stocks popped, and investors await that December jobs data later this week. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Hey, Josh, yes, we're going to start with a record for Nvidia. So we had Alphabet almost hit a record high, didn't quite get there, but we're going to take a look at Nvidia. So shares were up over 3% today, Josh, closing at a record high. About $149 a share, a little over $149 a share. And really, this was in a broader rally in the semiconductor space. So you take a look at semis today, Josh, a lot of good news here being priced in from positive news out of Foxconn. Of course, a company that deals with all of these chip companies, right? If I can find Micron on our screen here, Micron up over 10%. But one thing I wanted to highlight was just Nvidia rallying into this Jensen Huang speech that we're waiting for after the bell today, right, at CES. So a lot of people had sort of speculated, can Jensen say something that will spark a rally in shares? Well, you already got your big move today, so can he really say anything more tonight to surprise people? I think will be one of the looming questions going into
I saw some analysts trying to take their best guess what he thought he would highlight, and at least some were thinking look for headlines on robotics, gaming, autos, maybe he announced some new partnerships. And then tomorrow they have this separate sort of financial analyst Q&A, and maybe that's where you get some more news on that bread and butter data center business. You could see that potentially moving the
something to watch tomorrow, I'm sure, as shares will be trading while they're actually speaking tomorrow, so that should be interesting for sure, Josh. Second thing I wanted to highlight, so trading on Trump here, we're going to take a look at the US dollar index, Josh. So early this morning, perhaps maybe even earlier than we were in the office, around 6 a.m., the Washington Post came out with a story essentially insinuating that the tariffs under the Trump administration might not be as severe as initially thought.
Oh, yeah.
Yeah. And so this is what happened with the dollar as that came through, right? So really the move over the last couple months has been dollar higher because of tariffs, right? So if we think less tariffs than previously thought, well, we're going to see the dollar come down. Where the action got interesting to me, around 9 a.m., 9:15, this is when President-elect Trump took to Truth Social.
Says not so fast.
He says fake news, that's not accurate, this is inaccurate reporting, and the market moves. And really, Josh, my takeaway from this being, we're back in this kind of market now. This is going to be the market action for 2025. You have a president coming into the White House that is not afraid to just put things out on social media, say his opinion, and it's going to be moving markets, and that's going to be a big trend I'm going to be watching in 2025.
Yeah, I mean, he keeps telling you he likes tariffs, and his team likes tariffs. Bessent likes tariffs. Lutnick likes tariffs, right? So
they're being pretty outspoken about it, yes. But I think the degree to how significant those tariffs are
for sure.
What the market's debating right now. A final one for you, Josh. We're going to go back to our screen in a second here. Waiting on that jobs report, and this is kind of what I think is going to be the key market driver of the week. If I can get us to the 10-year Treasury yields here. So we've been talking a lot about this increase in yields, right? And the question's been, well, what can move us lower? How do we get a breather? We had this jobs report on Friday, and one of the takes out there is, well, if the jobs report is weak, maybe that's not necessarily a bad thing if you're looking to get off 4.62 on the 10-year, your highest level in 8 months. Maybe a weak jobs report Friday could actually be a boost for equities, was something that Piper Sandler's Michael Kantrowitz had proposed. On the flip side, you sort of wonder how much higher can yields really go if there's a positive report. And so we'll have to just a little bit wait and see, but we're going to get an early read into how 2025 is trading as far as is good economic news, good news for stocks, or bad news for stocks. It'll probably depend on what way yields move.
And what are economists expecting? Fireworks, or what are we looking for?
Generally more gradual cooling is the word we're hearing, right?
Crashing.
So remember, cooling, not crashing, sort of that continued theme. About 155,000 non-farm payrolls expected to be added. That's less than last month, but 155 still a pretty good number. Unemployment rate's a little bit debated right now between staying steady at 4.2 or moving up to 4.3. But even a move up in 4.3 wouldn't be that much from a decimal point perspective. So right now, no one's expecting a crazy report, which would mean if we do get something more interesting, we might have a fun day on Friday.
All right, we shall see, Joshua. Thank you. On the latest episode of Financial Freestyle, host Ross Mack catches up with Matt Garland to discuss down payments on homes and the importance of using the bank to your advantage. You can scan the QR code below to catch up with the latest episodes, and be sure to tune in to Financial Freestyle every Monday at noon. And here's a clip from today's episode.
if you're buying a primary residence, you don't have to put down 20%, right? And I'm a fan of OPM when it comes to this, other people's money, meaning I'd rather use the bank's money and finance as much as I possibly can on this property so that way I can use my capital for other things and other investments so I can make money. Now, you only want to do this if you can afford to play this game, right? We're putting less than, 20% down if you can afford it, right? But some of the programs, FHA, 3.5%, you have knocker loans out there. You can do 100% financing.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Nvidia stock closing at a record high today. CEO Jensen Huang giving a keynote address tonight at the Consumer Electronics Show. For more on what to expect, we're bringing in now Gil Luria, Head of Technology Research at D.A. Davidson. Gil, it is always great to see you and have you on the show. So listen, let's start there, Gil. Nvidia CEO Jensen Huang speaking tonight at CES. What do you expect to hear from the man, Gil? What do you think he's going to focus on?
Well, first and foremost, I hope he takes a victory lap. I mean, what NVIDIA's been able to accomplish, even just in the last couple of years, is absolutely remarkable. Just from a year ago when he spoke, the company was going to deliver $100 billion of revenue. They're going to well exceed that now. And going into this year, they may deliver as much as $200 billion of revenue. And along the way, they've made possible a remarkable number of innovations by other companies and that we're only just starting to benefit from. So I think that's going to be a big part of it. The second part will be him talking about what they can still accomplish, what AI can be used for in terms of new applications in different verticals, in medical sciences, in software, in other parts of technology. And hopefully he'll introduce some new ideas and new use cases that we can get excited for this upcoming year.
Do you think, Gil, he gives any news on that, bread and butter data center business that investors are so excited about?
He may talk a little bit about the evolution of the product, how many Blackwell servers they're starting to deliver, hopefully say some qualitative things about that, talk about the next generation of product. NVIDIA's now on a once a year product cycle, so they're barely starting to roll Blackwells out, and they're going to start talking about the next generation. So hopefully adds more details about those products and how much leap forward those capabilities have. So I'd expect that to happen today. They have an analyst meeting tomorrow where we may get some more financially oriented information regarding that data center business.
Now, Gil, if I was a viewer and I was listening to your intro there, I would say, man, this guy sounds bowled up on Nvidia. But you're not, Gil. You're neutral. You got basically a hold on this name. How come?
I like to think of myself as maybe the least bullish of the 60-something analysts that cover NVIDIA. And the reason is that I think this is a cycle just like any other cycle we've ever seen, which is to say this may be the peak year of the cycle. For NVIDIA stock to be attractive from here, you would need to believe that it can grow 15-20% into next year and the year after that. We think that may not happen, that as Microsoft gets its fill, probably by the middle of the year, Amazon and Google get more of what they want. They're not going to grow their CapEx by the same rates they've grown them the last couple of years. And if that's the case, NVIDIA may not be able to grow into next year. In fact, at some point, it may even start declining. And our estimate for 2026 is well below consensus estimates for that reason. And if that's how things play out, obviously it's going to be very hard for NVIDIA stock to outperform.
Do you think, is it possible that the hyperscalers, those cloud giants you just mentioned, Microsoft, Amazon, Google, that they stop spending as much as they are right now, that chip spending spree kind of slows? But could, Gil, in that event, applications, industrial AI, sovereigns, could they actually pick up the slack?
So two categories there. There are the companies that are buying AI services from Amazon, Microsoft, and Google. Most software companies don't buy their own chips. They just use capacity from those hyperscalers. And if those companies start having applications that are tremendously successful and are driving growth, they'll keep buying more hyperscaler capacities. The hyperscalers will want more chips, and this growth will continue. We have yet to see that. We've yet to see enterprise applications really getting to a point where they need more and more capacity because they're driving growth. So that needs to happen for growth to continue from that side. In terms of non-hyperscaler customers, there's a couple of really good ones. Tesla and Meta are using this capacity to make their product better, to sell more full self-driving in Tesla's case, to sell more ads in Meta's case. Those will persist as long as they get those gains. In terms of other types of customers, we're a little bit more skeptical. When NVIDIA uses the term sovereign, they usually just mean international data centers that are subsidized by the government. There's not a lot of governments out there getting into the business of operating data centers. That's not something governments get into. They do sometimes subsidize the hyperscalers, and that will continue. But again, if hyperscalers have enough capacity, they won't necessarily seek those subsidies. And a lot of the rest of NVIDIA's business is really self-funded. It's neo hyperscalers that NVIDIA is investing in. Those companies are then in turn borrowing money and then turning around and buying NVIDIA chips. That's a good complementary business for NVIDIA. It keeps the hyperscalers on their toes, but it's not necessarily a business that you want to continue to grow from there.
Gil, always great to see you and have you on the show. Thanks for joining us.
Thank you, Josh.
Stick around, much more Ask for a Trend still to come. For our chart of the day, we're looking at broadening trends in the market. Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Well, if you've been looking for broadening last month, you weren't going to find it, Josh, and that is the subject here. There's a lot of debate about what happens now in terms of broadening in the market, but we haven't seen a lack of broadening thus far in December. This is coming to us from Bank of America Global Research, and effectively, this is the percentage of stocks on a monthly basis that are outperforming the S&P 500 during that month, right? So the percentage of stocks that have been outperforming has been going lower. And in fact, according to Bank of America, reached a record low in December, going all the way back to when they started tracking this in 1986. And not only that, it was sort of trending lower over the past couple of years. The breadth has been worsening. This is all part of the trend that we've been talking a lot about, which is that really the performance of the S&P 500 has been dominated by a handful of mega cap tech stocks. The question is what happens now? The team at Bank of America, as have others, points out that it is expected that profit growth performance will start to catch up to some degree with large cap tech, the rest of the market, and that large cap tech profits, the growth will start to slow down. They're not going to meet, but that they'll be going more in the sort of going towards meeting, if you will. But in the shorter term, are we going to see that broadening? Jonathan Krinsky is a technical analyst over at BTIG, and he says, not only looking at the month, but the end of December saw very negative breadth. He says we got an overdue, oversold bounce. That maybe was happening sort of today. And he says now we really have to watch closely to see what happens next. Jim Paulson, who we talked to earlier, pointed out in a recent note as well that when you tend to see this kind of negative breadth, things kind of stall out for a little while in terms of index performance. So again, a lot of debate about what happens here, both in the short and then in the medium term, but we're going to keep watching some of these breadth indicators to see what happens next.
All right, thank you, Julie. Taking a look at some trending tickers now in the after hours trading. Shares of Ulta getting a boost. That's after announcing a C-suite shakeup. The beauty retailer announcing its CEO, Dave Kimball, is retiring after 11 years with the company. He served as CEO since 2021. Kimball will be replaced by Keisha Steelman, the company's president and chief operating officer. Ulta also raising its fourth quarter outlook in the announcement, saying the company saw a stronger than expected performance during the holiday season. Next up is Meta. Meta just added 3 new members to its board of directors and got a little tougher here in the process. The tech giant announcing it is appointing UFC president and CEO Dana White to its board, with White saying in a statement, "There is nothing I love more than building brands, and I look forward to helping take Meta to the next level." Also joining are Exor CEO John Elkann and Charlie Songhurst, former head of global corporate strategy at Microsoft. The addition brings Meta's board to 13 directors, including CEO Mark Zuckerberg. And turning now to shares of Stryker and Inari Medical, the medical technologies company Stryker, to acquire Inari Medical, deal representing a total fully diluted equity value of about $4.9 billion. Inari's product portfolio to complement Stryker's neurovascular business. And that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.